Happy New Year to everybody, and thanks everyone for joining us at our January installment of the SEC Roundtables. I think I can speak for everyone at Haskell and White when I say that I wish we could all be back in the friendly confines of the Center Club, meeting in person like we've done historically. But as we've done so many times in 2020, we're going to make lemonade out of the lemons, and we're going to keep pushing forward. And as they say, the show must go on. So we're doing it virtually, and this is the first virtual conference that we've done like this. So we've got a jam-packed agenda today. So put on your seatbelts and get ready, because there's a lot of material to cover today. And as much as we've all seen that, whether it's the SEC or the PCAOB or the FASB, the regulators have really tried to be sympathetic towards businesses, and they've really tried to minimize the amount of regulation and new standards. And we've even seen some delays in implementation of certain requirements. But even with their help, there's just still a lot of new information here. And as we get into the 10K season and the audit season, there's just still a lot of information that we want to share with you today. So what we've done is we've kind of employed our divide and conquer strategy, where we've picked 4 really important topics, and we want to share some information with you on those 4 topics. So so Diane and Wayne and Pat and I, we're all going to take a section and go into that with you. We are going to try to save some time at the end to do some Q&A. So if you do have some questions as we go through the materials, we're going to ask that you type that into the chat feature in Zoom, and we'll try to address some of those at the end. If we don't get them at the end, we certainly can reach out to you after the conference is over and give you our thoughts on any of the questions that you might have. Let's share just a little bit of information about the wonderful accounting firm that's presenting today's program. So just a couple words about Haskell and White. We are a middle market focused accounting and advisory firm. We work out of 2 offices, Irvine and San Diego, and we're also backed by a global alliance of firms. And as the world continues to shrink, we find ourselves working more and more with those firms as our clients expand into different geographies. We are a great place to work, and we're a corporate role model, and you don't have to just take our word for it, because we got lots of hardware to back that up. So we're really proud of the role that we play in the community. What we bring to the business community is technical competencies and experiences of the larger firms, and we've combined them effectively with the attentiveness and the responsiveness of what smaller firms are typically known for. And in an entrepreneurial environment like we have in Southern California, we think that there's a great need for that in our market. On any given day, you'll find us working as auditors for accelerated and non-accelerated filers. You'll find us consulting on SOX and other ICFR matters, and you'll find us advising privately held companies. Maybe there's an exit, or could be an IPO, or it could be even just an onboarding of maybe a private equity or a VC funding. Our commitment to quality is demonstrated with favorable regulatory inspection reports. We have a fantastic group of people. A lot of our managers are participating on the call today, so we work really hard to recruit and retain the top professionals in the industry. And the length of our client relationships is pretty astounding as well. Some of the clients that we have on the call today have been with us for 10 or 15 years. So again, speaks to the commitment to quality that we maintain at our firm. So this next slide is the group of presenters today, and I think you will all agree that with such a young-looking group of presenters, how could this group possibly have over 125 years of combined experience advising companies? So it's a pretty impressive group, and no jokes about the young comment too. So speaking of impressive and speaking of young, I will introduce our first speaker, who's our managing partner, Wayne Pannell. So Wayne, it's CAM time.
It is CAM time, and I just want to acknowledge that one of us got a little bit older today, because we want to recognize that it is actually Rick's birthday today. So you can send him out some virtual plugs and well wishes, but you know, like some of us don't seem to age, but he's been catching up lately. So we want to talk about CAMs. For most of you on this call, CAMs is going to be a new thing for December year ends that have just occurred. One of the clients on the call, I know we have been through CAMs for just the first time last year because we had a accelerated filer with a March year end. So they were our guinea pig to go through that. So I know we can share some results from that. But for the rest of you that this may be new, hopefully it's not an unknown and you're hearing this for the first time today. But we want to quickly walk through what they are, a little bit about why they are, when they're required, what some of the common CAMs have turned out to be, how they're being communicated. And I forgot to remove number 6. I didn't actually put any example in here, but we can point you to a lot of different companies that are out there. I do want to acknowledge a source of a lot of this information. There's actually a very good study that the Center for Audit Quality just put out in December, actually about a week ago. It's their year in review paper on critical audit matters. The link is there. As one question was asked already, we'll send the slides out to you and the link will be live, so you'll be able to go right out to that. It's fairly interactive and you'll see some of the information that came out of there. So without further ado, let's just get right into what they are. And so this is probably a strange presentation because this affects us as your auditors, or those of you that are clients. It affects your auditors a little bit more than it does you in the sense that this is an audit standard that we have to apply for companies. So the PCAOB has in their audit standard AS 3101 in reporting, which is a newer standard that's been updated in the last few years. They've defined a critical audit matter as, I'll just read it here, something that arises from the audit of the financial statements that was communicated or required to be communicated to the audit committee and meets these 2 bullets. It's going to relate to accounts or disclosures that are material to the financial statements, and it involves some type of especially challenging, subjective, or complex auditor judgment. So if we think about that for a minute, those of you that have been in audit committee calls, those of you who are on audit committees and you've had presentations by the auditors, there's a whole list of required communications, and you'll know that we get into conversations about accounting methods, accounting estimates, and those types of things. The things that we have talked about traditionally in those meetings, which have been for audit committee ears and eyes only, are going to be now a little bit more potential for the eyes of your investor community, the users of your financial statements. So when we look at the critical audit matters, and look at the next slide, just an excerpt out of 3101, it's a lot of small words there. But what they're basically suggesting, requiring the auditor to be looking at when we develop the CAMs that will go into our report, are anywhere, for example, where we have assessment of risk of material misstatement, where there's significant judgment involved because management's created a number of estimates. There's unusual transactions involved in that particular reporting period. There's a lot of subjectivity potentially in the procedures we had to apply that year, or maybe we needed to get some specialized knowledge from business evaluation people or some other things that really will go back and affect estimates as well. The very bottom of that is actually, it is right out of their words. They do expect, the PCAOB that is, that the auditor would determine that there's at least one matter involving some type of challenging, subjective, or complex auditor judgment. So, so I think anybody who's not received an auditor's report with CAMs yet could be expecting to receive one or more. And we'll show you some results from the survey that have come up here in a little bit. So answering the question why on the next slide. Oops. Thank you, Megan. One ahead of me. Okay. So the answer of why on the next slide, the PCAOB put out a release back in June of 2017, leading into this whole revamp of the audit report. And it's been a continuing effort on their part as they've reached out to the investment community. And I'm not exactly who's saying what, but the feeling that's come back through these surveys is the investor community is looking for more information about what's going on in an audit. And when you scroll all the way through this list of bullets here that I lifted out of their release, they did 6 years of public outreach and comment to try to formulate the ideas that people wanted to know more about what's going on in the audit. And the reality is the audit report, but for some cosmetic changes and some mild wording changes over just the last 4 or 5 years, there's only been a handful of minor changes in that audit report since the 1940s. So to some degree, it was looking at a bit stale and dated, and they thought they needed to upgrade a little bit. So when they went through that analysis, quoting right out of there, they thought that CAMs would likely be identified in areas that investors are most interested in, and therefore they're looking at the auditors to supplement the discussion of their audit, much like management's already gone through in the MD&A, but getting a little bit more thought out of what the auditors were thinking or the challenges the auditors were thinking. I know from a soapbox standpoint as auditors, we think it starts giving a little bit more roadmap to potential other auditors to think about how they might, look at that job a little bit differently, but we're all going to be on the same playing field here in terms of what we're disclosing. A critical thing in here, though, is these are not meant to be boilerplate, which I'll stand on a small soapbox here for a moment. I think they are in early stages starting to look boilerplate. So we gotta figure out how to not fall on that. So when they're effective, as on the next slide, as I mentioned early on here today, the large accelerated filers have already been dealing with this. Anybody with a June year end of 19 and since has already been adopting this. And we have one client that went through this last summer with us. Elsewise, all other public companies, with one exception, are required to do this for fiscal years ending after December 15th of 2020. So those of you that are preparing for your audits, upcoming with us or somebody else here in the near term, you are going to have CAMs in there. The one exception being, and I know we have another client on the call that fits in this boat, is if you went public under the Jobs Act and you're still in your emerging growth company status, you get a little bit more of a delay because you're working off your 5-year calendar when you'd have to adopt a number of things. But for the most part, in this filing season, we're going to see a major catch up of the companies all putting CAMs out there through their auditors' reports on their financials. So if we look at the next slide, out of this same survey from the Center for Audit Quality, they went through the S&P 100 and just as their source base to go through. And it's a good little study. I think we've seen other studies during the year that have looked at larger public companies. And I don't think the results are too different in this population versus others. This graph is right in that the source out there. But when you look at it, the top 4 things that they came up with, the common areas for discussion were taxes, income taxes. And a lot of that has to do with some of the major changes in tax laws over the past couple of years. Goodwill and intangibles, again, with valuations, potential for impairments, contingent liabilities, which can run the gamut from litigation to other things, what kind of estimates and judgments would in there. And of course, our old friend revenue recognition would make the list. I'm actually a little surprised revenue is not the top of the list, but revenue certainly is in the top 4. And then that covered 51% or 51 of those 100 companies. The other 49% of the findings fell across some 23 different areas. So there is some other things that are onesie twosies, if you will, that are making it into that. But again, we think about where the judgments, where the estimates, where the complexity is. So those of you looking for CPE online, we're going to actually challenge you and everybody else to answer the first polling question that's out here. How many critical audit matters do you expect your auditor to include in their audit report? And we'll give you a little bit of time to answer that, and Megan can tell me when she gets a good result. We'll put up the answers from this small, rough, non-statistical poll here and see what we think is going on in our local community.
Okay, we're about 74%. So I'll give it about 6 more seconds. You guys are pretty quick. So let's see. Okay.
And the answer is?
Yep, that sounds good. I'm going to share the results.
All right. So out of this fine population we have here, we have 38%, assuming Haskell and white people didn't answer this question, 38% of you in the public reporting community think you're going to have 1 critical audit matter discussed. Next batch of population is 2. So that actually aligns very nicely with the next slide, which will show you that the S&P show that on average there was 198 CAMs across that population, which averaged out to 1.98 CAMs per company. And so we had our own survey come out 1 to 2, and it's just under 2 in this presentation here. So you see 43 out of 100 had 2, 32 had 1, and coincidentally none had none, right? On the idea that there could be 0. And I just one final comment on that before I move off here is the PCAOB does have in their audit standards the possibility that a company might not have a CAM but they give you some instances of how that could be, what their thought process on and what it would be. But they also pretty clearly give you a raised eyebrow kind of look in the wording there that that would be really unusual to have none. So I don't personally expect to see companies with zero. So as far as communicating CAMs in the auditor's report, they take various shapes and forms, and from an example standpoint, you could go look at Microsoft, you could look at Apple, you could look at any large company, Ford, GM, et cetera, that's out there, and you'd see the various firms' methodologies for reporting the CAMs. Some have done them with a very bullet point type effect. Some have written full paragraphs. But in all cases, what they've had to do is cover these four boxes here. They've had to identify what the CAM is, the principal considerations to why the auditor thought it was a critical audit matter to be disclosed, how we address that issue in the audit, and then the relevant financial statement accounts or disclosures that are related to that CAM. So if you just think about revenue recognition, there might be some complexity in your revenue model if you're not a simple widget retailer. So we might have to get into what factored the subjectivity, the critical estimates, et cetera, into revenue and talk about what we did to get through that process. So I'll leave that there because I'm probably close to my 10 minutes there, and I know we want to keep this moving. So I'm actually going to hand it back to the birthday boy and let Rick talk about this year's big topic, the COVID-19 impact on financial reporting.
Thank you, Mr. Pannell. Logically, since we're just talking about the auditor's report, it's a very logical transition to talk first about going concern. And just to remind everybody that management has guidance in the FASB codification for going concern assessments, and it came through on ASU 2014-15, which is now codified in 20540. But before that was issued, there was really no guidance out there for management when it's preparing its financial statements. Management teams were really working off of an audit standard. But that all changed with the introduction of this new ASU. So I want to remind everybody that it's out there, and that there's a lot of good information in that ASU. And there's definitions about what does substantial doubt mean about your ability to continue as a going concern. And what you're going to see is it means that it's probable that the entity is not going to be able to pay its obligations over the next 1 year period. So those definitions are there for you. There's a couple other things that I highlighted in this bullet point about what's in the ASU, and just in terms of maybe a couple of areas that sometimes we see our clients struggling with, and maybe some things that they forget sometimes. One is when you're thinking about the evaluation period for a going concern, we have to look at a 12-month period, but sometimes people think it's a 12-month period from the balance sheet date, right? So we're just closing our books for 12/31/20, but really what we should be looking at is not 12 months from the balance sheet date, but 12 months from the date the audit report is issued or your 10K is filed. So we're really, if you're going to file your 10K in March, then we're got to be looking 12 months from March when the filing is made. Couple other things to remember. If you do say, hey, we think that there's some uncertainty, if we've got financing and liquidity to get through the next 12 months, but we've done an analysis and forecasting and our financing plans, and we say, okay, we think everything's great now. Well, that doesn't mean that you don't have any going concern disclosures, because in those cases, you still would have disclosures to make in your financial statements about what management's plans are. So, hey, we're going to invest in some sales and marketing, and we're going to reduce some expenses, and we've got these financing plans. That would all still need to be disclosed, even if you concluded that there is no substantial doubt and it's been alleviated. And then, of course, if the conclusion is there is substantial doubt, so, hey, we're losing money and financing is really tough for us right now, so there is substantial doubt that we're going to be able to continue, what you're required to do under the standard is expressly state that in the footnote disclosures, that there is substantial doubt about the company's ability to continue as a going concern. So that's got to be in the disclosure. It'll be in the audit report, but this is, again, going to be in management's financial statements. So those are a couple things to remember. Also, the requirement to assess going concern, it's not only an annual requirement that you make in your annual financials in your 10K, but you got to do this every quarter. And again, when you think back to the 2020 year and the uncertainties and how tough the 2020 year was, those assessments have to be made on an interim basis. So That's a really important thing to remember. And again, sometimes we see our clients not always remembering that. There's a little, I'm sorry, Megan, just to show that little chart there. You could see after we went through the Great Recession back in 2007 and 2008, we had a spike in the going concern reports that the graph shows. But really, we've had economic expansion ever since then, and that going concerns that are being reported is really a straight line down for the next decade. There's no data out yet on 19 and 20, but when it does come out, I think, again, we're going to see, especially due to COVID, we're going to see a big spike in the going concern type of companies. The SEC's already told us that. The AICPA's told us that as well. We just don't have the data for it yet. So another quick polling question, if we can get your opinion on this. So do you think that you will be having conversations with your auditor about a potential going concern situation for your company this year, given the COVID pandemic and given how difficult it is to really forecast what the future might hold in terms of cash flows? Wow, that's pretty much
We're almost there.
Mm-hmm.
Okay, a few more seconds, and then I'll close the poll. There we go. I'm going to share the results, Rick.
Mm-hmm. Yeah, thank you, Megan. Yeah, so wow, 53% are saying yes, and 48% are saying no, and a few that are unsure. So again, not unexpected given the environment that we're in. So my advice is have those conversations early, start them early, and again, provide evidence. If you think you've got sufficient liquidity and sufficient plans, provide that evidence, because that's what the auditor is going to want to see. So thank you, Megan. That was great. So moving on, let's talk about asset impairments. Asset impairments are really tough because it's a complicated area in GAAP. And what makes it really tough, I think, for a lot of companies is depending on what asset you're talking about, we have different rules that we have to apply. But one thing that's very common among all of these things is the triggering events that requires you to make an impairment assessment. And a lot of the triggering events are present in our current environment because they're things like macroeconomic slowdowns. We have rising unemployment. We have lower business activity. So there's lots of evidence. We have the pandemic, of course, that we're in the middle of. It'd be hard to argue that there's not these triggering events out there that would require you then to make an impairment test. Doesn't mean you have impairment, but it just means you have to go through the process and make an assessment. So we've tried to give a little bit of a roadmap for you on this slide of where in the codification you got to look for guidance when you have to do these impairment tests. So again, just know that, again, there's different tests for different assets. The right of use assets that we have now with lease accounting, and we've onboarded our lease assets, those fall under the fixed asset impairment rules. So we'll follow that model. The deferred income tax asset is really tough in this environment because companies might be losing money and they might be forecasting to continue having losses. And if that's the case, it's going to make it really hard not to have some type of allowance against the deferred income tax assets. Because again, the business environment is not real robust for a lot of industries right now. So that's a tough one you want to get ahead of. And then please don't forget about receivables and inventory, the allowance for doubtful accounts, the allowance for slow moving or obsolete inventory. We can't leave those folks behind. And then when you do some work around the impairment area, it's important to remember a term that we call sequencing. And sequencing really refers to what order do you test in? And a good rule of thumb is just kind of test in the order of liquidity. So I would look at receivables, inventory, investments first. And of course, goodwill would be the very last thing that you want to test for. That would be the proper way to sequence your impairment testing. Revenue recognition has a few items I think we need to think about in a COVID environment. One is variable consideration. So some of the things and the behaviors that you might expect your customers might have in terms of price concessions, or maybe things like royalties or rebates, those may be behaving differently in this environment. And that's going to require you to go back and look at your transaction price. How much do you think you'll be able to realize on a transaction price? Because actual events may be differing than maybe what you thought previously, just because the economic environment's different. So you might have to revisit that variable consideration, change your transaction price, which might change the amount of revenue you're recognizing. The SEC has also advised us to be thinking about contract enforceability. So if you go back to the 5-step process we have in the new revenue standard, the first step is identify the contract with the customer. And you've got to meet certain criteria to be able to even call it a contract. And one of them is you've got to think it's probable that you're going to have collection, and the contract has to be enforceable. Well, what happens if you're in a remote environment and you can't get all the signatures on the contract the way you normally do? The SEC has advised that maybe you don't have an enforceable contract. If you don't have an enforceable contract, then you're not under the standard, and you are defaulted into a very, very conservative revenue recognition posture to basically where you have to have no chance of refunding any money and all your performance obligations have to be satisfied. But it puts you in a very, very conservative posture. So that's something you might want to think about as you kind of think about your revenue recognition pattern. On lease accounting, concessions are very, very normal in this environment as we've gone through the year 2020. So of course that raises the question, did we modify a lease, or was that concession really something that was embedded in our lease contract and we had the right to that concession? Well, the standard setters gave us a break here because they know that that's a tough analysis to do. And if you're a company that has 20, 40, 60, 80 leases, to go through each one of those leases and figure that out would be really tough and really costly. So the FASBs told us all that, hey, if you have a concession that the landlord's given you, then you can just consider that to be a right that was within your lease contract. So you didn't modify a lease. That was already in your lease agreement. So it allows for a little bit more of a simple accounting and less analysis. So that was something that really was positive. On abandonment, what we have to remember with the lease abandonment, again, if we've decided, hey, we don't need all the space, if we're a retailer and we've shut some stores, if we've really abandoned the lease and the asset, then we cannot have any intent to sublease that property. If we still have an intent and we have an ability to sublease, then you really haven't abandoned it. So that's one thing to keep in mind there. One of the most frequent questions we all get is on PPP loans, and there's different schools of thought out there in terms of should we be accounting for this as debt using a debt model, or should we be using another model, something like IAS 20, which might allow us to treat it like a government grant and basically record the loan forgiveness as we expend those funds in accordance with what we're supposed to be spending it on. So there's a conversation you want to have there. The debt model is by far the cleanest. It's the most non-controversial, but there is a basis to say, look, maybe we can apply by analogy IAS 20 and maybe use a grant accounting model. And that would get us to some loan forgiveness a little bit quicker than the debt model would. Because remember, under the debt model, we have to wait until we have legal release from that liability, which won't happen until you get notified by the SBA that your loan has been forgiven. So then there's a couple of options here. So again, you want to talk through that internally because again, there are some options here. Couple items here I want to share with you on some guidance from the SEC. So the SEC was really active early on with COVID. They issued what they call disclosure guidance that they call Topic 9 in March. They updated it in June with Topic 9A. But I think the takeaway you want to have with this is really what the SEC is asking you to do in your disclosures, and primarily in the MD&A section of your 10Ks, is that common phrase that you hear from time to time that says through the eyes of management. And that's really what the SEC is encouraging here is they want to know through the eyes of management how your company is dealing with COVID, how you're responding, and what type of trends you see going forward. So again, I would encourage you, these aren't real lengthy documents, but they do ask a lot of really good questions. We've put in an example of a question that they asked in this document. And the purpose here is just to stimulate some really good disclosures by the management team. Non-GAAP measures is something the SEC has talked a lot about too, because as you can imagine in this environment, there's a lot of companies that are taking liberties at creating their own non-GAAP measures here, particularly if the business isn't performing very well. So again, the SEC has given us some warnings and they said, give us a balanced approach and no cherry picking what you put in these non-GAAP measures. So they've given us some guidance, and the guidance is there in those 3 bullet points. So if you want to have an adjustment to your GAAP earnings, the adjustment's got to be directly related to COVID or the economic downturn. It's got to be incremental to your normal operations and non-recurring in nature. And then they are asking that it's going to be quantifiable. So for example, it's not okay to say, hey, if we didn't have COVID-19, we would have had another 20% of revenues. But it's all COVID-19's fault that we missed out on that extra 20%. The SEC would say that's not objectively quantifiable, and they would not permit that type of non-GAAP measure adjustment. Last but not least here, just a couple words on financial reporting, just because, again, the auditors, the PCAOB, the SEC know that everybody's working in a different environment right now, and that might create additional risk. So again, the auditors are going to want to know what is working differently this year. What changes have you made with COVID? How has it impacted internal controls? And how has the experience been? So there's also a requirement that we have to remember that changes to your internal controls that are material need to go in your quarterly reports. So we have to keep that in mind too. I'll leave with just one statistic that really made me do a double take. The Association of Certified Fraud Examiners surveyed 2,000 financial executives, and 79% of those executives said that they've observed an increase in fraud over the last year, given the remote environment. And what's even more stunning is 90% expect an increase in the upcoming year. So I think we all have to recognize that in this environment, and you've probably read a lot about cybersecurity, and again, there's a lot of issues around that given the remote environment. But financial reporting fraud and misappropriation of assets, those risks are increasing in the environment we're in now too, and that's something we all need to think about. So with that, I will stop talking and turn it over to Diane and ask Diane to give us some news on restatements.
Okay, thanks, Rick. Today we're going to take a quick look at restatement trends, including the types of restatements, the underlying issues causing those restatements, who's doing the restating, are they accelerated filers or non-accelerated filers, and then also the severity of those restatements. So as you can see on this graph, the 6 years from 2009 to 2014 were pretty stable, flat. And then the restatements started dropping after that to a 19-year low of 484. And the severity of those was also decreasing, which we'll get into in a little bit. To clarify for you the difference between the gray bar and the blue bar, unique filers versus restatements, if ABC company restated 2 times in 2019, in that gray bar, they would only be included once, but in that blue bar, they'd be in there twice. So just to define that for you. So the total restatements they were relatively stable, then they've been declining. So let's break down a little bit more detail and see what's behind those numbers. So as you all know, there's 2 types of restatements. There's revision restatements and reissuance restatements. So the revision restatements are the less severe type. These are the ones that don't require that item 402 8K disclosure of non-reliance. And therefore, by definition, since we're not saying you can't rely on the financials, these are less disruptive, if at all disruptive, to the market. And you can see that the percentage of these less severe types of restatements has been growing over all the years in this chart to just slightly under 80% in 2019. And 2019, that's the highest percent since 2005, and 2005 was the first full year that 8K disclosure was in effect. It was required starting in August of 2004. So next slide, Megan. The reissuance restatements are the more severe type, the ones that do require that item 402 8K disclosure, stating that the past financials can no longer be relied upon. And you can see quite clearly on this graph that except for a minor uptick in 2018, the numbers of these more severe types of restatements have been in a continuous decline down to 85 in 2019, which is the lowest since that requirement came into effect in 2004. So now what's causing these restatements? We have a quick polling question for you. Megan, are you getting that? There you go. So if everybody could submit their guess on that polling question.
About 15 more seconds of polling. We have about 80% of people in right now. Okay, I think we got everybody. I'm gonna share the results, Diane.
Okay. Okay, well, we've got a smart group of people here because 69% of you said revenue recognition, and the next most popular, liabilities, payables, reserves, was 24%. So if you go to the next slide.
Okay, here we go.
The revenue recognition was the correct answer, so most of you got that right. I've listed the top 7 for you here, but on the next slide, I've got them in graphical terms. And it's interesting to note that even though revenue recognition was in the #1 slot for both 2018 and 2019, before that, for 13 years, from 2005 to 2017, the #1 slot were issues around debt, quasi-debt, warrants, equity types of issues. So, you know, as you all know, those debt equity accounting issues are some of the most complicated in the accounting literature. So it shouldn't be too surprising that that was the #1 issue for restatement for 13 years straight. And then in 2018, ASC 606 became required. And so then in 2018 and 2019, RevRec bumped debt and equity, and RevRec became the #1. In 19, actually, the debt equity issues fell to the 3rd slot, and cash flow reclassification issues was #2. So we've seen a lot of that happening on the cash flow statements, with things not being classified, and there were some recent ASUs issued on clarifying some of those classification issues because they were seeing a lot of errors there. So the top 3, really revenue recognition, the debt and equity accounting issues, and the cash flow classification issues. So now who's doing the restating? Megan? Accelerated filers versus non-accelerated filers. So although the total restatements from accelerated filers experienced just a minor uptick, as you can see, to 206 in 2019, that uptick followed 4 years of consecutive decreases. And in addition, and perhaps more importantly, the more severe reissuance restatements from accelerated filers totaled only 32 in 2019, 32 from all accelerated filers. And that's the lowest since 2005, when that disclosure requirement came into effect. It's also interesting to note from this graph that the gap between the two, between accelerated filers and non-accelerated filers, is shrinking, and that 2019 was the second year that accelerated filers actually restated slightly more frequently than the non-accelerated filers. So now let's take a look at several factors that play into the severity of restatements. One factor that plays into the severity is the average number of issues per restatement. So you can see that on this graph, the average number of issues ranges between 1.5 and 2.5 over the last 20 years. And we are currently at the historical low of right around 1.5 issues per restatement. On the next slide, the average income adjustment per restatement is also at a historical low, the lowest in the 15 or 14 years on this slide by a lot. So again, the severity is going down. And then the next slide, the percentage of restatements with no impact at all, we're at 56.8%, which is the third highest number on that slide. So on the next slide, all these factors are indicating the severity of restatements have been going down. The average number of issues is at a low. The negative impact on net income, the largest adjustment in 2019 was $276 million. And that was the lowest in the last 18 years. And compare that to the largest adjustments back in 04 and 05 that were 6.3 billion and 5.2 billion. So really the numbers are going down. And then as we mentioned, that the average net income restatement was down to 1.2 million in 2019, and the percentage with no impact on net income is down. And then lastly, the number of days restated, which is defined as, back to that item 402 8K disclosure, the non-reliance period is what they mean when they say the number of days restated. That non-reliance period decreased from 500 days in 2018 to 451 in 2019, which was the lowest number during the 19 years that were analyzed. So on the last slide that I'm going to present to you, I just have it summed up here as the annual restatements. You can see that the last 6 years have negative growth. So the number of restatements is going down, the severity is going down. These are all really good trends, but I do want to encourage you all to continue to be cognizant of those top 3 issue areas: the Rev Rec, the debt and equity accounting, and the cash flow statement classification issues, so that we can continue these positive trends into 2020, 2021. So with that, I'm going to hand it over to Pat to talk about business acquisitions. Pat, are you on mute?
Yeah, unmute Pat.
Okay, now everybody can hear me. So yes, for the last part of our presentation here, we're going to go through the updated SEC rules regarding significant acquisitions. As most of you know, have gone through the process. If the registrant requires a significant target company, there's certain 8K reporting requirements, and the audited financial statements of the target have to be filed with that 8K. And also pro forma information needs to be disclosed. As Rick mentioned at the beginning, the SEC has tried to lower some of the burdensome requirements on registrants, and this was one of those areas to maybe kind of raise the bar a bit of what qualifies as significant acquisition. And in the further slides, we'll go through what the tests are and the modifications to that. This has been really the only update to this area of the SEC rules in the last 30 years. So as much as the business world has changed, maybe they're trying to keep up with the current operating environment. Also, thanks, Megan. So just the notable changes there in the bullet points at the bottom. As I mentioned, the definition of significance, there's some changes to that in the test. Also, they conformed, you also have to follow the 8K rules if you dispose of a business and provide pro forma information as well. So they align what's significant between the acquisition and the disposition test, revise some of the pro forma reporting requirements, and then reduced to the number of years the target company you need to provide audited statements to a maximum of 2 years on the larger acquisitions. Right, as I mentioned, the significant test has 3 elements, and if you trip any one of these, it would be considered a significant acquisition, which would require you to obtain the audited financial statements and go through the 8K reporting requirements. The first item is an investment test, and again, this is a mathematical numerator denominator item where you're comparing your investment or whatever the consideration was exchanged to acquire the subsidiary. But now the new denominator of that is not just the historical equity, it's the market cap or worldwide market value of the registrant. So that's going to probably not trip the acquisition to be significant in a lot of companies, because now you're lowering or increasing the denominator. I'm trying to get my math straight. The whole Common Core stuff is coming back to me now. So, all right. And the next slide, the asset test is pretty much the same. Again, you'll do a numerator denominator test of what the asset of the target versus the assets of the registrant. And then the next test is the income test, which this is one of the other changes where you're comparing the net income of the target versus the net income of the registrant doing the acquisition. The value of the net income is now continuing operations before income taxes, not net income. So it'll pull out any of the other weird stuff at the bottom with taxes or other comprehensive income or any other measurements below the line. And now there's also a revenue component with comparing the revenue between the target and the acquiring entity as well. So to summarize those main changes to the test, for the investment test, it's now worldwide market value. You're only going to have 2 years at the maximum. That's a smaller acquisition. You're only going to have 1 year. We'll go through what those bright line tests are. And then also, if once you have the entities consolidated for a period of 9 months or a complete year, you don't need to keep presenting the pro forma financial information. And then if you are only required to have 1 year as a smaller significant acquisition, you don't need to show comparative interim financial for the prior period. And also the other big change is if you have for some global companies that have, subsidiaries or other acquisitions or report on IFRS, that is permitted to submit those financial statements if they're already audited. All right, our polling question here. So we want to just gauge and see from everyone participating, if you're going to do some acquisitions in 2021, what's the likelihood of that? So if it's the first bullet point, maybe not relevant to you, but we see this come up from time to time with a lot of our companies. So we'll see what everybody's temperature is for acquiring businesses in 2021.
Okay, we're pretty close. So a few more seconds, and I think we're good. I'm going to share the results right now. Yeah, just got one more. Okay, that's pretty good. Do you see impact?
Yeah. I think 35% neutral, which is, kind of not unknown. It's a big step to acquire companies, so that doesn't surprise me. Not likely at all. Maybe a little surprising. I guess don't say always or never, so never know what opportunity is going to rise. But looks like, it's the 12% of very likely and likely, with the 5%. So looks like some people out there still have an appetite for going through, acquisition and hopefully improving their business.
Okay, next slide.
All right. So here's kind of just the chart on, the bright line test. Again, same rule before. If you don't have, if the acquisition on those significant tests is below 20%, there's no 8K reporting requirement and doesn't qualify as significant. The next tier is it's greater than 20%. Whoops, you go back, Megan. If it's greater than 20%, but less than 40%, you only need to have 1 year audited financials. And then greater than 40%, that would be the situation where you'd have to have 2 years of audited financial statements in the requisite interim reporting period. All right, we'll move on. And just the kind of changes to some of the pro forma criteria. The presentation now is going to have you define, some of what those pro forma adjustments are made, and now it's going to have to be reported in a columnar format where you'll have the, entities, historical financials, and then the transaction accounting adjustments, which are, what effect of the actual transaction will be. And then also there's going to be another column for what they call autonomous entry adjustments. This would be more for a spin out, or if something is going to look on a standalone basis, those would have to be separately presented. And then any sort of management adjustments that would depict the synergies or dyssynergies, those are permitted, but they're only going to be allowed in explanatory notes to the information and not actually presented in the columns with the actual numbers from the transaction accounting adjustments. All right, so that slide just kind of summarizes what I described on the prior slide with the chart. And again, I think just the big change there is kind of limiting the use of management's adjustments and being presented with the pro forma information right along next to the others. Right, and then just the last piece I mentioned, the rules do apply to dispositions of the business, and now that just requires the pro forma information for those disposals or trip that 20% of any of those tests with the investment, asset, or income test. All right, I believe that was it for my part, so I'll hand it back over to Rick.
Yep. Thanks, Pat, for the good news. Less work is good news, so appreciate that. Thanks, Pat.
Okay.
So we're nearing the end of today's program, but there's still just a few items that we wanted to make sure were on your radar, because there's a few other significant changes that you really need to know about. So one of them is on the changing definitions of the SEC's filer categories. And what I would focus your attention on this slide is really those two middle rows, because how you get into an accelerated filer category has changed. And the reason the filing categories are important, because that really dictates the time that you get to file your 10Ks and your 10Qs, but it also dictates whether you need an internal control audit or not. And so what the SEC did this year is that they made it tougher for you to be an accelerated filer. By introducing a new revenue requirement. So if you focus on those two middle rows, you'll see under annual revenues that in order to be an accelerated filer today, you need to have 100 million or more of revenues, unless you've got a crazy market cap of over 700 million. So that's a big deal. So that means a lot of these smaller companies that maybe went past the 75 million market cap, but maybe they didn't have 100 million of revenue. Those companies are no longer going to be accelerated. So you don't need the internal control audit, and you still get to use the full 90 days. So this was a major win for especially the smaller public companies. And again, really moving the needle towards simplification and being easier to be a small public company in the United States. On the next slide, there are some big changes to Regulation SK. So please talk to your securities counsel. There's changes that are going to be effective for this 2020 10K that you're all going to be filing here in the next couple months. So changes to items 101, 103, and 105 are going to be effective for this year's 10K. So there's changes to the business section, there's changes to the legal proceeding section, and there's changes to risk factors. And there's significant changes too. So for example, on risk factors, if you've got more than 15 pages of risk factors, the SEC is going to require you to have a summary in there. And the SEC is also going to require you to organize those risk factors a little bit differently. So there's some big changes here to really try to streamline the 10K a little bit more. So be sure you're working with your securities counsel so you know what those changes are. The two other items here, 301 and 303 on MD&A, those again are big changes. Fortunately, though, those are not going to be required by the SEC until next year's 10K. So that'll be for the 2021 10K. But those, you need to know what those changes are because it's going to dramatically change the 10K. Couple other things to keep on your radar. What an awesome year 2020 was for IPOs. There were 480 IPOs in the US. And of course, a big driver of that was all the SPAC activity, special purpose acquisition companies. There were over 250 SPAC IPOs during the year, and those included things like Pershing Square's $4 billion SPAC, and Virgin Galactic and DraftKings were some high profile companies that went public via SPAC. That momentum is carrying into 2021, so you're going to continue to see some very active public markets. Focusing on environmental, social, and governance causes, that continues to have a lot of momentum in financial reporting. The investors continue to want that. So watch for more SEC rulemaking in that area, especially as we move forward with a Democratic administration. I think you'll see more emphasis there. Last year, we got some SEC and some IRS tax deadline relief around COVID. Everything that we're hearing from the regulators say don't expect that again this year. So don't expect any pushing out of the SEC deadlines. Don't expect any push outs on any of the IRS deadlines. That doesn't seem to be in the cards at the moment. But in terms of good news, again, what the AICPA is reporting is that, again, a lot of the rule makers and the legislators are really focused on stimulus. They're focused on keeping this economy going. So don't expect any major changes in the corporate tax regime, at least for this year. If we do get a pickup in the economy later on this year, of course, all bets are off. But what the AICPA is reporting is don't expect really any major tax regime changes, at least for the 2021 year. So as I told you at the beginning, there's a lot of material to cover. So I know we were able just to touch on just a few areas. We're happy to answer anything you have via the Zoom chat feature. If we can't get to it today, you can reach out to us at any time at your leisure. You know, we're always happy to have a conversation and provide some more information if there anything that we went too quickly over or things that we weren't clear on today. Megan, is there anything at all in the chat that you want to share or we go through?
I don't see any questions in the chat.
Okay, then I think what we can do is, again, wish everybody a happy 2021. And thank you again for joining us today. We will be back again in the summertime with our next installment of the SEC Roundtable. And again, anything that comes up between now and then, please reach out to your friendly neighborhood Haskell and White auditor, and we're always happy to have a conversation. So thank you again for joining us and have a fantastic rest of your Wednesday. Thank you.